So today, I'd like to speak to you a bit about considerations when doing business outside of the typical major North American jurisdictions, and what to look at when dealing for M&A or financing transactions in the mining sector in the countries of south of the Rio Grande. So basically Latin America, but it applies as well to Africa or Southeast Asia or something like that. So it's what's your back, Jack? So we're gonna see what's your back's about when dealing with clients doing business south of the border. First, general considerations is that when doing a deal, an M&A or a financing deal in the mining sector in Latin America, you gotta go with a very open and different attitude, because many things work differently in host jurisdictions than they do in North American countries, and not only because of the difference between equity and civil law, but in many other aspects. There's a difference in procedures, timings, idiosyncrasies, etc. So you gotta go with an open mind. And basically, in host jurisdictions, some things that work in North American jurisdictions simply don't work. Such, for example, as free flow of funds, for example, investment protection. There are aspects that you have to take into account in terms of structuring and documenting your transactions that are, outside of the scope or beyond the scope of a typical transaction that you would make if your mining project was located in Canada or in the US. The third aspect, and it's very important, is that change is a normal, in politics, in economic conditions, etc. So you gotta provide in all your structuring and documentation for flexibility and possibility of changes. So, for example, in Latin America, if you are doing an oil and gas transaction and or a mining transaction, and you require some kind of a permit or government approval, sometimes it doesn't happen. So you have to wait for the next government to happen. So you have to basically provide for that. Governments are very fickle in this jurisdiction. So a couple of years ago, we tried to do a deal in Ecuador for a client, and there was a journalist that spoke against the deal, and then the politicians wouldn't approve the deal. The government wouldn't approve the deal. The client had to wait until the next government to get the deal approved. And then, of course, there are also political issues that make sometimes complicated to close deals. For example, if you look what happened in Panama a couple of weeks back, the government approved a huge mining contract for First Quantum, Minera Cobre Panama, which is one of the largest copper mines in the world. They had been operating for several years now, but their contract was declared unconstitutional by the Supreme Court. And then the government and the Senate went into negotiations with the company, approved a new contract, and because of 1,000 people went out to demonstrate, the government got spooked and canceled the contract. Now Panama is facing a huge investment arbitration because of canceling that contract. And of course, that contract was the first tax revenue of Panama, even in terms of hard taxes, greater than the canal. So that's something that you always have to provide for. And last but not least, local advice is key. So even in the early stages of any negotiation, you have to include local counsel, because there are local aspects that have to go into documents. And some counsel from major jurisdictions, they want to compartmentalize what they share with local counsel. that is not good. I mean, you have to provide local counsel with enough context so they can give you, proper and comprehensive advice. That's very important. And second, cheap is expensive. You need good local counsel. You need to recognize local counsel's capabilities. In jurisdictions like ours, there are many sole practitioners or small firm practitioners that are very good at regulatory stuff, but are not good at transactional stuff. So you have to recognize those capabilities and be able to choose a counsel that works for you or works on the transaction. And it is important in this, or I found very helpful in this kind of situations, the use of our platform, our Dentons platform. Sometimes we at Dentons don't have the capabilities, or we need to team up with other firms, and the platform is very useful in that kind of situations. One of the most important aspects of any deal, M&A, but especially financing, is flow of funds. You have to take into consideration taxes on exits of funds, such as the case in Ecuador, for example. You have to take into account restrictions on flow of funds, like in Argentina or Colombia. In Colombia, there is what we call here an exchange channel. So you have to make sure that you bring money into Colombia in a way that you can take it out legally and efficiently. Otherwise, you're gonna end up in the black market and stuff like that. And in Argentina, for example, you have a situation like you have to take the money in at the official exchange rate, which is lower than the real exchange rate, and then the official exchange rate devalues as well. But then when you're gonna take your money out, you cannot access the official exchange rate, so you have to do the market exchange rate. So you end up taking dollars in at 50 cents and getting them back at 120. So you have to structure for an efficient flow of funds in and out of the host country. And this also deals, with the official market rates versus exchange rates. There are countries that are dollarized, such as Ecuador and Panama, and there are countries allowing for US dollar transactions like the Dominican Republic, Guyana, Peru. So you have to look at what you're dealing with in order to be able to plan how to protect the value of the money that you are getting into one country for the moment that you have to take that money out of the country. Then, of course, a big aspect of structuring a deal, M&A or financing in a jurisdiction outside of where lenders or investors are, is tax efficiencies and investment protection. In terms of tax efficiencies, you have to, of course, look for DTTs, double taxation treaties or treaties for avoiding double taxation. And you may want to do some foreign shopping in order to structure your investments from jurisdictions where there are double taxation treaties with the host country. You have to work on your payment structures. For example, in PMPAs or what they call streaming agreements, usually you have a lender ashore and you have a seller of the stream minerals offshore as well, in order to avoid withholding taxes in the host country. We're going to see it right now. And then, of course, sometimes you gotta fund your operations through back-to-back operations in financial institutions to take advantage of tax efficiencies. So, for example, if you do shareholder loans and the shareholder is not a financial institution, then you are taxed more heavily on the money that you take back than if the lender is a financial institution. So you do a back-to-back with a financial institution, and let's say they charge you 1.5%, but you avoid a 10% withholding tax. And investment protection structuring, which is quite important. You have to check for BAT, so that's a bilateral investment treaty, or FIT, so that's free trade agreements between the host country and the country of the ultimate controlling parent, in order to check if there are investment protection provisions that would allow you to access, investment protection, investment arbitrations, international investment arbitrations, in case that you are expropriated or you're not treated fairly. And then if there's no treaty, then you have to go forum shopping. So you have to structure your investment from a place in which there are, BITs with the host country. And then, of course, on forum shopping, you have to comply with timing and substance requirements. So you have to do forum shopping before you do your investment. You cannot go forum shopping once a conflict has developed, because then you will not be recognized as an investor of that country. And sometimes you need substance requirements in the jurisdiction that you're taking advantage of in terms of BATs, in order to be able to determine such jurisdiction as the investment jurisdiction when you go to an investment treaty arbitration. So that's important. This is just to visualize what we're talking about. For example, you have offshore holdco 2 trying to do an investment in a producer, a host country company. So you do it through a back-to-back with a financial institution outside or offshore, so you can get a financing or a reduced taxation on the flow of funds in and out. Or in the case of a streaming, for example, you make sure that the seller of the stream minerals is, for example, here offshore holdco 2, in the sense that offshore holdco 2 selling minerals to the offshore streamer will not generate any taxes on outflow of funds or any withholding taxes. Whilst if you do from the producer host country to the streamer, you will probably be hit, or the streamer will probably hit with those taxes. So the streamer wants the closer to receive the closest amount to what they're selling, and they don't want to be bothered by withholdings and taxes. So they structure it that way. And then, of course, if you have an offshore streamer, you don't have dividends or withholding taxes when you're going to the parent, or when you're dealing with the off-taker, then also depending on the jurisdiction of the off-taker. But this is very important in order to structure deals, because the first instinct that you would have is that you will have the producer selling the stream minerals directly to the off-taker or directly to the offshore streamer, but that's going to end up being inefficient, especially if you are the counsel for the offshore streamer. So that's stuff that you have to take into account. Then security structure is very important. The first thing that you need to determine is whether your security is aimed at securing cash flow or securing value of assets. So you need to get an asset back in a case of default, or you need to take control of a project, or you need to take control of the cash flow of the project. Also, you have to recognize the efficiency of security, because there's sometimes security which cost is not value for money in terms of what is being done. So there are assets that are non-material and that you could leave out of security and leave it for someone else. Sometimes you have to do that as well. And of course, you have to identify assets that are indispensable for operations. So what I'm trying to tell you is that in a typical security package, you secure everything, but securing everything is not sometimes as efficient as, for example, securing the assets is not sometimes as efficient as securing, for example, cash flows, especially if as a lender, you are trying to protect your client in case of a default by the borrower, in making sure that you be able to take control of a going concern instead of a bunch of assets that are going to be in the aggregate way less value than a going concern. So in terms of going concerns, the security must allow the continuous of operations, and the security must minimize the permitting for the transfer of that going concern to a new purchaser, and the tax impacts of that assignment, in case of default. Then, in terms of offshore structuring, first you're gonna have a required substance. You're gonna fill required substance criteria for any offshore structures that you are putting in place. You have to be able to you should be operating a jurisdiction, an offshore jurisdiction that is not a tax haven determined by the host country, because that will negate all the benefits of an offshore jurisdiction. Jurisdiction should have English capabilities. It should have no taxes for foreign operations. Well, that's the definition of a tax haven. It would be great if it had a decent financial system. So it's very different, to operate in Cayman or in the BVI than to operate in Belize or St. Vincent and the Grenadines or something like that. And of course, not too much bureaucracy. For example, you go to Barbados, and in Barbados, if you're going to do foreign currency operations, you have to have a foreign currency permit, and that's sometimes a hassle. And then, of course, in terms of tax efficiencies, I want to go back here. Many times, you would ask yourselves, why do I have a parent company and then an offshore holdco 1 and an offshore holdco 2? Well, first, because sometimes when your clients, they want to develop a project and then sell it. So if they sell the assets in the host country, they're gonna be hit by taxes in the host country. So you should sell assets in an offshore jurisdiction or through a corporate, I would say a corporate transaction in an offshore jurisdiction. But then if you do that and you didn't have the offshore holdco 1, you'll be hit with a gain in the parent company jurisdiction that will probably be subject to taxes. So if you sell offshore holdco 2, you will get, and you have offshore holdco 1, you will have your gains in offshore holdco 1, and then you don't have to pay taxes in that jurisdiction. It's a tax haven, and you probably don't have to pay taxes in parent company jurisdiction just yet. For example, in Canada, I know that if you do this, and then if you redeploy within certain time your funds to another project, then the parent company wouldn't have to pay taxes for the gains of the offshore holdco 1. So this is a typical, structure that works in terms of tax efficiencies. And then, of course, interim structures for deals subject to authorizations. Sometimes when you close a deal or when you do a deal, the client wants to take a hold of the assets immediately. But sometimes the closing of those transactions are subject to authorizations, such as antitrust authorizations, qualifications of the assignee by the authorities of the host country, first right of refusals, etc. So sometimes, in order to, I would say, to give economic effect to the transaction without having closed a formal assignment of the assets, you may enter into operational agreements, trust agreements in order to hold assets, etc., etc. That has to be done in a way that is compliant with the regulations of the host country. You have to be able to do these structures in a way that unraveling them will not cause a trauma to operations or to the transaction, And of course, you have always to be ahead of the curve in terms of risk evaluation and mitigation of the things, because sometimes you got to be, firmer with the client in terms of, what are the risks of doing an interim structuring of operations like this, and if it's worth that risk or not. Finally, there are specific issues or matters that you have to take into account when structuring deals to be funded through international capital markets. First, you have to be aware that in order for an acquisition to be funded through a company that is listed in Canada or in the US or in Europe, you're gonna probably need technical reports, in terms of mining or oil and gas as well. Those technical reports are going to include legal descriptions, and you have to be on top of that, because in these technical reports, these legal descriptions are usually made by the geologists or engineers, and that's a disaster. So you have to be able to at least review and correct those descriptions. And of course, the issues of these technical reports are subject to regulations of security of information and data collected. So you have to make sure that the protocols have been followed by the technical consultant, so it doesn't come back to bite you afterwards. Then, of course, all the assets that you're going to be acquiring through, or they're going to be destined to be held by a listed company, will require that assets or companies have financials that are audited, that comply with international accounting standards, such as IFRS. So you have to make sure that they have it, and you have to plan for this from the beginning, because I've been in many transactions in which this is not planned from the beginning, and then you're ready to close and you don't have audited financials. And audited financials take time, especially in connection with assets that are located in a host country that had not been that had not had a proper accounting and stuff like that. So this is something that you have to take into account from the very beginning. Then, of course, in terms of RTO structuring, which is reverse takeovers or structures where you have local shareholders or seed shareholders that are swapping their equity for equity of listed companies, you have to take into account trading and timing restrictions for those newly issued equity in a listed company. You have to manage expectations, because if you have the owner of a mining asset and you're offering them shares in exchange for the value of their assets, and you give them shares that are 4 months restricted, then you may have a problem. So you have to manage the expectations. And of course, last but not least, investor presentations. Investor presentations are subject to compliance with securities regulations of the investment country, and to forward-looking statements. And you have to make sure that these are included in the investor presentation, and they're accurate. And also in investor presentations, but not also in investor presentations, but also in I would say in prospectuses or information memos like that, the role of counsel in terms of identifying risk factors that are local, and in order to properly draft and structure the risk factors is very important. So sometimes you take a precedent or a model risk factor chapter and you throw it into your prospectus. That doesn't work. I mean, you have to work closely with local counsel in terms of identifying risk factors and presenting them properly. I've had many cases in which something as stupid as a badly written risk factor becomes a liability for the company in the long run. So again, I just wanted to give you a little context about the stuff that you have to look for when you do cross-border transactions in the mining sector, especially from the point of view of us, south of the Rio Grande, and hopefully this will help you in your transactions in the future. And hope we do many of them. Thank you.